Hey there, welcome. Have you ever wondered how these massive companies or even entire governments find the money for their gigantic projects? Well, today, we're pulling back the curtain on one of the most important tools in their toolbox, bonds. We're going to break down what they are, how they work, and how you could be a part of it. So let's start with a name we all know, Reliance Industries. Let's imagine they've got this incredible new plan, a huge expansion, something that's going to create a ton of jobs and new products. There's just one tiny little problem. It's going to cost billions. So how on earth do they get their hands on that kind of cash? It's not like they can just stroll into the local bank and ask for a loan that big. And that question, right there, is the key to understanding this whole world of bonds.
So let's think about their options. A company that needs that much money really has a pretty fundamental choice to make.
Okay, option one. They could try to find one massive bank, or maybe a whole group of them, that's willing to lend them an absolutely astronomical sum of money. But that's complicated. It comes with a ton of strings attached, and honestly, it might not even be possible.
Or there's option two. Instead of getting one gigantic loan from a single place, they could get thousands, maybe even millions of tiny little loans from regular people, from people just like you. And that, right there, is the big idea. This is the fundamental mindset shift when it comes to bonds. When you buy a company's bond, you're not just some passive investor. You are literally stepping into the shoes of the bank.
And this image here really paints the perfect picture, doesn't it? On one side, you've got the company, Reliance, and they need cash. On the other side, you've got the public. The bond is that contract, that bridge in the middle that connects the two. You give them money, and in return, they give you a promise to pay it all back plus interest.
Let's just state this as clearly as possible, because if you remember one thing, this should be it. When you buy a bond, you are the bank. The company is borrowing from you, and they are legally on the hook to pay you back.
Okay, so if we're going to be the bank, we'd better understand the terms of this loan, right? We got to read the fine print. So let's follow a fictional investor, we'll call him Mahesh, who's deciding to lend his money to Reliance.
First thing we need to know is the face value. The easiest way to think about this is that it's the principal on the loan. It's the original amount of money that Mahesh is lending, and it's the amount that Reliance promises to give him back when the loan is all done.
So in our example, the face value of Mahesh's bond is 1,000 rupees. Nice and simple. That is the lump sum he is guaranteed to get back when this is all over.
But of course, you're not lending money for free, and that's where the coupon rate comes in. This is basically the interest payment the company gives you every year to say thank you for letting them use your money.
For Mahesh's bond, that coupon rate is 10%. That means every single year, Reliance is going to pay him 10% of that 1,000 rupee face value. So he gets 100 rupees. That's his reward for being the bank. And finally, every loan has an end date. The maturity date is simply the day the contract is finished. On that date, Reliance will give Mahesh his last interest payment, and they'll give him back his original 1,000 rupee face value. Loan complete.
Okay, so the terms are pretty clear. But just like any loan you'd ever make, there's always that question of risk. I mean, not all borrowers are created equal, which brings us to a really crucial point.
This is where something called credit ratings are incredibly important. You have these independent agencies that basically give a company a report card on its financial health. A high rating means it's a super safe loan. You're very likely to get paid back. But because it's so safe, they offer lower interest. A low rating, well, that means there's a higher chance the company could run into trouble. So to get you to take that risk, they have to offer much, much higher interest.
And this really just illustrates one of the golden rules of all investing. As you can see here, risk and potential return are always linked. Low risk, like a bond from a super stable company, means lower, more predictable returns. If you want a shot at a higher return, you absolutely have to be willing to accept more risk.
All right, so now that we've got the fundamentals down, let's zoom out a bit. Because the word bond doesn't just refer to one single thing, it's a huge universe with all different types of loans.
First up, you've got government bonds. In this case, you're lending money to an entire country. And since governments can, raise taxes to pay off their debts, these are generally considered one of the safest investments on the planet.
And then, on the complete opposite end of the spectrum, you have something called junk bonds. These come from companies with those low credit ratings we were just talking about, which makes them a much riskier loan. So to convince anyone to take that gamble, they have to offer really high coupon rates.
And bonds can even be tied to a specific purpose, which is pretty cool. For example, green bonds are used to fund projects that are good for the environment, while yellow bonds are specifically for financing solar energy. It's a way for you to put your money towards causes you actually believe in.
So, we've covered what a bond is, we've gone through the key terms, the risks, and the different types. But what's the one single dynamic that every bond investor absolutely positively has to understand?
This brings us to the bond market seesaw. This is a crucial concept, so let's walk through it. Imagine you own a bond, and it's paying you a steady 5% interest. Now, what happens if interest rates in the whole economy go up, and suddenly new bonds are being sold that pay 7%? All of a sudden, your 5% bond doesn't look so great, does it? If you wanted to sell it, you'd have to offer it at a discount. Its market price goes down. But let's flip it. What if interest rates everywhere else fall, and new bonds are only paying 3%? Well, now your 5% bond looks fantastic. It's in high demand, and its market price goes up. This inverse relationship, interest rates go up, your bond's price goes down, is the most important dynamic to get your head around.
Which really just leaves us with a final thought. In a world with wild stock market swings and all this economic uncertainty, there's a certain appeal to an investment that's, well, kind of boring and predictable, right? One that just promises to pay you a fixed amount on a fixed schedule. So, you have to ask yourself, in a volatile market, is that boring predictability exactly what a smart investor needs? It's definitely something to think about.